Welcome to the video. Today we are going to understand one of the most important accounting standards, which is IAS 1, presentation of financial statements. I have drafted this in very simple way so that it will be easier for you to understand. The contents includes introduction, objective of IAS 1, scope of IAS 1, complete set of financial statements, fair presentation and compliance, key assumptions, consistency and comparability, materiality and aggregation, structure of financial statements, notes to financial statements, comparative information, and common errors. Now, before we begin, let me ask you one simple question. Imagine there are two companies presenting their financial statements in completely different formats. One shows expenses first, and another shows revenue first, and the third one mixes everything together. Will you be able to compare them properly? Obviously not, right? And that is exactly why IAS 1 exists. IAS 1 basically provides a standard way of presenting financial statements so that they are clear, consistent, and comparable across different companies and different time periods. Now, let's understand the objective of IAS 1 in a very simple way. The main objective of IAS 1 is to ensure that financial statements are presented in a structured and consistent format. This helps users like investors, bankers, and management to understand the financial position and performance of the company easily. In short, IAS 1 is all about clarity and comparability. Now, talking about the scope of IAS 1. IAS 1 applies to all general purpose financial statements that are prepared under IFRS. However, it does not apply to interim financial reports because those are covered under IAS 34. Next, let's understand what exactly is included in a complete set of financial statements. According to IAS 1, a complete set includes five main components. First, the statement of financial position, which we also call as a balance sheet. Second, the statement of profit or loss and other comprehensive income. Third, the statement of changes in equity. Fourth, the statement of cash flow. And finally, notes to financial statements, where we get each and everything about the details of the company. Now, think of it like this: the balance sheet tells you what the company owns and owes. The income statement tells you how much profit it made. The cash flow statement shows how cash is moving. And the notes provide detailed explanation, right? So together they give a complete picture of the business. Now let's move to one of the most important concept, which is fair presentation and compliance. IAS 1 requires that financial statements must present a true and fair view of company's financial position. This means the information should not be misleading. Companies must follow IFRS standards properly, and only in a very rare situation they can deviate, but they must clearly explain the reason. Now let's talk about some key assumptions. The first one is going concern concept. This means when financial statements are prepared, it is assumed that the business will continue operating in the future. For example, if a hydropower company in Nepal is running today, we assume it will continue its operations for many years. So it's asset and recorded accordingly. The second assumption is the accrual basis of accounting. This means transactions are recorded when they happen, not when cash is received or paid, right? For example, if you make a sale today but receive cash next month, The sale is still recorded today. Now let's understand consistency and comparability. IAS 1 requires that companies should use the same format and accounting policies every year. You may question why. Because if a company needs or keeps changing its format every year, it becomes very difficult for performance comparison, right? Also, companies must present previous year data along with current year data. So, if you are showing financial statements for 2025, you must also show for 2024 figures. This helps user identify trends and performance changes. Next is materiality. Materiality simply means importance. If something is significant, it must be shown separately. If it is not significant, it can be combined with other items. For example, buying a pen worth of rupees 50 is not important enough to show separately. But buying machine worth rupees 50 lakh must be clearly shown in the financial statements. Now let's think or talk about the structure of financial statements. IAS 1 requires proper classification of items. Asset and liabilities must be classified into current and non-current. Current means items that will be realized or settled within 12 months. Non-current means items that are long-term. For example, a loan payable within 1 year is a current liability, but a loan payable after 5 years is a non-current liability. This classification helps user understand the company's liquidity and long-term stability. Now coming to notes to the financial statements. Many students ignore this part, but it is very much important. Notes provides detailed explanation about accounting policies, assumptions, and important judgments. They also give additional details that are not shown directly in the main statements. So, if you are really wanting to understand financial statements deeply, you should always read the notes. Now, let's discuss some common mistakes. This is the of comparative information. Now, talk about common errors, right? One common mistake is incorrect classification of assets and liabilities. Another is lack of proper disclosure. Sometimes company also fail to maintain consistency in presentation and many times comparative information is missing. All these mistakes reduce the reliability of financial statements. Now let's quickly summarize everything. IAS 1 is the foundation of financial reporting. It ensures that financial statements are presented in a clear, structured, and comparable manner. It includes important concepts like fair presentation, consistency, materiality, and proper classification. And it helps user make better financial decisions. So, in simple words, without IAS 1, financial statements will be confusing and difficult to compare. But with IAS 1, everything becomes standardized and easy to understand. Thank you so much for watching this video. And if anything missing, please reach out with me in comment section. If you found this helpful, you can like the video and subscribe for more simple explanation on accounting and finance topics. See you in the next video. Thank you.